43% gross margins. In a manufacturing business, in an industry where most competitors are lucky to hit 25, that's not a typo. That's RBC Bearings. And that single number tells you everything about why this stock has crushed the S&P 500 over the last decade, while almost nobody was watching. Today I'm breaking down the 3 specific reasons why RBC Bearings deserves your attention right now. Not tomorrow, not next quarter, right now. Because when the market finally figures out what this company actually is, you don't want to be chasing. Let's get into it. Reason number 1. Those gross margins aren't an accident. They're a moat. Here's what most people don't understand about bearings. They think commodity. They think interchangeable metal parts. They're wrong. RBC doesn't make the bearings in your skateboard. They make mission-critical, highly engineered precision components for applications where failure is not an option. We're talking aircraft landing gear, submarine propulsion systems, medical robotics, applications where customers aren't shopping for the cheapest option, they're shopping for the only option that won't get people killed. This is why RBC commands pricing power that would make a SaaS company jealous. Their products represent a tiny fraction of total system cost, but carry enormous liability implications. You're Boeing. You're building a $700 million aircraft. Are you really going to risk the whole program to save $900 on bearings? No. You pay RBC whatever they ask, and you sleep at night. The result? Gross margins that have averaged above 40% for years. Operating margins in the mid-20s. In manufacturing. Let that sink in. Now here's where it gets interesting. Reason number 2. RBC isn't just a great business. It's an acquisition machine. In 2021, they made a move that transformed the entire company. They acquired Dodge Industrial from ABB for $2.9 billion. That deal doubled their revenue overnight, but more importantly, it gave them something they didn't have before: diversification away from pure aerospace into general industrial markets. Why does this matter? Because the bearing and power transmission industry is massively fragmented. We're talking about a $30 billion global market with hundreds of small regional players, family-owned businesses, and subscale operations. RBC is consolidating this space methodically. Every acquisition they make, they apply the same playbook. Optimize operations, rationalize the product portfolio, cross-sell to existing customers, push margins higher, rinse and repeat. Since the Dodge deal, they've already made 5 additional bolt-on acquisitions. Management has stated publicly they have an active pipeline and the balance sheet to keep buying. They're not stopping. Stop for a second. Think about what this means for long-term compounding. You've got organic growth from strong end markets. You've got margin expansion from operational excellence. And you've got inorganic growth from strategic M&A. That's a triple engine of value creation. Most companies are lucky to have one. Reason number 3, and this is the big one: aerospace is entering a supercycle. The COVID hangover in commercial aviation is officially over. Boeing and Airbus have combined backlogs exceeding 13,000 aircraft. 13,000. At current production rates, that's nearly a decade of guaranteed demand. And here's the thing about aircraft: every single one needs bearings. Thousands of them. Landing gear, flight controls, engine components, auxiliary power units. But it gets better. Defense spending is surging globally. The U.S. defense budget just hit $886 billion. NATO allies are finally hitting their 2% GDP targets. Everyone is rearming simultaneously. Fighter jets, helicopters, naval vessels, missiles, all of it needs precision bearings, and RBC is designed into these platforms. When you're designed into an aircraft or a weapons system, you're not competing for that business anymore. You are the supplier for 20, 30, sometimes 40 years of that platform's life cycle. Parts, replacements, aftermarket service, all of it flows to RBC. This is why aerospace companies trade at premium multiples. It's not hope. It's contractually locked-in revenue visibility stretching decades into the future. Now, I'm not here to sell you fantasy. Let's talk risks. RBC trades at roughly 26 times forward earnings. That's not cheap. The market has started recognizing quality here. You're paying up for a reason, but you're still paying up. If we hit a recession and aerospace production gets pushed right, this stock will get hit. Period. Second, Integration risk is real. They're still digesting Dodge, they're still making acquisitions. M&A can destroy value just as easily as it creates it if management gets sloppy. Third, customer concentration. Aerospace OEMs have leverage. If Boeing or Airbus ever decided to squeeze suppliers, RBC would feel it. These risks are manageable, but they're not zero. Eyes open. Here's my takeaway. RBC Bearings is exactly the kind of company that builds generational wealth quietly. It's not going to make headlines. It's not going to trend on social media. It's going to compound at high rates for years while everyone chases the next shiny object. 43% gross margins, disciplined M&A, decade-long aerospace tailwinds. This is the kind of stock you buy, hold, and let time do the heavy lifting. If this analysis helped you see something you didn't see before, hit subscribe. I do deep dives like this on overlooked quality businesses every single week. Most finance channels chase hype. We chase value. See you in the next one.